So, what does it really take to achieve financial freedom in Canada once you're over 60? Well, today we are putting together the definitive guide for the 2026 landscape. If you're ready to start building a smarter financial future, do me a quick favor and hit that like and subscribe button. Your support helps us create more of these explainers. All right, let's dive in.
Let's start with the big question, right? We're going to use a real-world scenario to unpack this. Picture it. Someone is 60 years old, they've built up a $5 million portfolio, and they are ready to call it a day. In the Canada of 2026, is that actually enough for a life of complete freedom? You know, the answer might surprise you. It's not as black and white as you'd think. Before our retiree can even think about spending a single dollar of that nest egg, they've got to face their first major challenge, the Canadian tax system. Because as we all know, it's never about what you make, it's always about what you get to keep.
So Canada uses what's known as a marginal tax system, and honestly the best way to get your head around it is to picture a series of buckets. Your income starts filling up the first bucket, and that money is taxed at a pretty low rate. Once that bucket is full, the income spills over into the next one, which gets taxed at a higher rate, and so on and so on. The key thing to remember is that the highest tax rate only ever applies to the money that lands in that very last bucket.
Now let's look at the actual numbers. When we combine the federal and Alberta tax brackets for 2026, you can see just how fast those rates jump up. You start off paying a reasonable 22% on your first 58 grand or so. But once your income gets up past $370,000, boom, you're suddenly paying a whopping 48 cents on every additional dollar you earn. That, right there, is the progressive system in action. And here's a detail that trips a lot of people up. Your marginal rate is that top rate you pay, that 48% on your last few dollars earned. But your average tax rate? That's the blended overall percentage you pay on your entire income. It's always going to be lower. And, understanding this difference is really the secret to smart tax planning. Okay, so with the tax landscape a little bit clearer, let's get to the next piece of the puzzle. How do we actually turn that $5 million nest egg into a steady, reliable, and sustainable retirement paycheck?
Now, what's really fascinating here is how that old rule of thumb, the 4% rule, has changed over the years. For 2026, the latest research suggests a 3.9% fixed withdrawal is a much safer bet. For our retiree, that means an annual income of $195,000, with a 90% chance that money will last for a full 30 years. And as you can see, other strategies might give you more income up front, but they do come with a little bit more risk.
A huge part of any Canadian retirement plan involves something called a RRIF, a Registered Retirement Income Fund. Honestly, the best way to think about it is like a 3-act play. Act 1, you spend your career accumulating money in your RRSP. Act 2, the government says you have to convert that RRSP to a RRIF by the time you're 71. And for Act 3, well, that's when the government forces you to start taking out money, which, by the way, is fully taxable.
And this is where the real challenge begins. Just look at the schedule. The government mandates that your withdrawal percentage has to go up as you get older. At 71, it's over 5%. By the time you hit 90, it's nearly 12%. This forced income, as it's often called, can accidentally shove you into higher and higher tax brackets, creating a massive tax headache if you're not prepared for it.
You know, that forced RRFI income leads us directly into our next section, what I like to call the minefield of hidden tax traps that high-income retirees face, especially when it comes to government benefits.
So let's talk about the Old Age Security, or OAS, clawback. The government officially calls it a recovery tax, but what it really is a system designed to reduce or even completely eliminate OAS payments for retirees who have high incomes. Essentially, the government gives with one hand and then takes it right back with the other.
This, right here, is the number that matters. I want you to burn this into your brain. For 2026, if your net income from the year before is above $93,454, that dreaded OAS clawback is going to kick in.
And here's how the math works. For every single dollar you earn above that threshold, the government claws back 15 cents of your OAS pension. So what does that mean for our retiree making $195,000 a year? Well, it means their entire OAS benefit is gone. Boof, wiped out. In fact, it disappears completely once your income gets to about $152,000.
So the crucial takeaway here is that you have to actively manage your income in retirement. This can mean delaying your OAS until you're 70, splitting pension income with a spouse who earns less, or, and this is a great one, strategically using your tax-free savings account, your TFSA, for big expenses, because that money is invisible to the tax man. It's all about keeping your taxable income below that magic number.
All right, let's switch gears a bit. We've talked a lot about income and taxes, but there is another huge piece of this retirement puzzle that can change literally everything: your postal code.
I mean, just look at these numbers. They're incredible. This chart shows the personal savings you would need for a comfortable retirement after government benefits are already factored in. So, to live comfortably in Vancouver, you'd need almost $500,000 of your own money. But look over at Calgary, it's nearly half of that amount. That is a staggering difference.
And the difference just gets more and more stark when you look at other cities. In Winnipeg, you'd only need about $158,000. This is what financial experts call geographic arbitrage. It's strategically using your location to slash your cost of living, which makes your retirement savings go so much further. For our retirees, choosing Calgary over Vancouver is like instantly adding another $1 million to their portfolio spending power. It's that significant.
Okay, let's bring all these different threads together now. We've looked at the taxes, the income strategies, the government benefits, and location. How do we combine all of that into one single, cohesive master plan for real financial freedom? Here it is. This is your blueprint for a successful retirement in 2026. First, you have to plan your income using tax-aware strategies. Second, you absolutely have to manage that income to protect your benefits from things like the clawback. Third, choose where you live wisely to make every single dollar stretch further. And finally, optimize where you hold your assets. For example, putting your highest growth investments into your tax-free account to shelter them completely from capital gains tax.
Which brings us right back to our original question. Is $5 million enough to retire at 60 in Canada? And the answer is a resounding yes. But, and this is a really big but, only if you have a smart, integrated plan. This is not a set-it-and-forget-it kind of situation. It requires active management of all these moving parts we've been talking about.
So if this breakdown helped you get a better handle on Canada's financial future, please just take a second to like, subscribe, and leave a comment. Your engagement is truly what helps this kind of knowledge reach more people who need to hear it. Thanks so much for watching.